Most Americans think of estate planning as a will and maybe a trust or two. But behind the scenes, the ultra-wealthy are playing an entirely different game, one that stretches the tax code to its limits and locks in generational wealth for centuries. Today, we're talking about how families like the Waltons and Pritzkers quietly move billions of dollars out of the estate tax system forever. They're not breaking the law. They're using it strategically. At the heart of this system are sales to intentionally defective grantor trusts, low-interest intrafamily loans, valuation discounts through family LLCs, and dynasty trust structures that exist outside the reach of estate and gift taxes indefinitely. This isn't just about tax savings, it's about control, permanence, and a kind of financial immortality. These are the tools of dynasties, used not just to preserve wealth but to concentrate power. In this episode, we're pulling back the curtain on the playbook. We'll walk through how each technique works, how they fit together, and why this planning is reshaping American wealth, quietly, legally, and irreversibly. At the core of modern dynastic planning is the Intentionally Defective Grantor Trust, or IDGT. The name sounds like a mistake, but that defect is the strategy. Here's how it works. The trust is designed so the grantor still pays income tax on the trust's earnings, but the assets inside are removed from their estate for gift and estate tax purposes. This setup creates two big advantages: tax-free growth. Since the grantor pays the taxes, the trust grows without any drag, supercharging compounding for the beneficiaries. Silent gifts. The taxes the grantor pays on the trust's income are effectively additional, tax-free gifts. But it gets even more powerful. Using a seed gift, typically around 10% of the value of what's going to be sold, the grantor sells appreciating assets, like a business or real estate, to the trust in exchange for a low-interest promissory note. No capital gains taxes are triggered, and the trust now holds all the appreciation going forward. If the assets grow faster than the interest rate on the note, called the applicable federal rate AFR, all that growth stays outside the estate, free from estate or gift taxes. In plain terms, a family business appreciating at 8% per year sold into a trust with a 2% note shifts 6% of annual value out of the estate. Multiply that over decades and generations, and you're looking at billions protected from taxation. It's the bedrock technique for permanent wealth transfer, and it's just the beginning. While IDGTs lay the foundation, intra-family loans add a critical second layer to the strategy. Wealthy families lend money to their heirs or to trusts, often funded with proceeds from prior planning, at the IRS-published applicable federal rate, AFR. These rates are intentionally low, typically between 3 to 4%, far below commercial terms. The borrower, often a trust, invests the loaned funds in assets that generate returns of 8 to 10%. The trust pays back the note at 3%, and the remaining growth stays in the trust, tax-free, outside the estate. It's legal arbitrage, made possible by the tax code. The beauty? It's not just tax efficient, it preserves control and introduces accountability. Heirs don't get handouts, they manage assets and debts. Families often prefer this over outright gifts. And because it's a loan, not a gift, it doesn't use up lifetime gift or GST exemptions. Combine this with a grantor trust and you get compounding, tax-free growth, low interest notes, and income taxes paid by the grantor as an indirect gift. Together, these tools move millions, sometimes billions of appreciation outside the reach of the IRS forever. So, how do ultra-wealthy families move even more massive value while staying under the gift and estate tax radar? They shrink the value on paper, legally, using family LLCs. A family forms an LLC and transfers assets, say real estate, a family business or a portfolio of investments, into it. The ownership interests in that LLC are then sliced up and transferred to heirs or trusts. Because those interests are minority shares lacking control or easy marketability, appraisers apply valuation discounts. These discounts typically range from 30 to 40%. That means an asset worth $10 million can be valued at $6 to $7 million for tax purposes. Less value equals less tax. But the underlying wealth remains intact, and courts have backed this up. In Pierre v. Commissioner, a 35.6% discount was upheld, even for an LLC that only held cash and marketable securities. The IRS isn't thrilled. They've tried to crack down, proposing regulations and increasing audit scrutiny, but savvy families work with experts to structure LLCs carefully and choose favorable jurisdictions, like Delaware or South Dakota, where default rules support restrictions on liquidity and control. In the wealthiest circles, discounting isn't a loophole. It's a core strategy, part of the playbook for moving maximum value with minimum tax exposure. Now we put it all together. After shrinking asset values with valuation discounts and selling them to a grantor trust in exchange for a low-interest promissory note, the final step is transferring those assets into a dynasty trust, a structure designed to last for generations. These trusts are GST exempt, meaning they avoid generation-skipping transfer tax indefinitely when properly funded. Combine that with the IDGT's tax-free growth, and the wealth is not just outside the estate, it's now compounding, untouched by future transfer taxes. Here's the full sequence. Form a family LLC to bundle assets and lock in valuation discounts. Sell discounted LLC interests to an IDGT using a low-interest note. Allocate GST exemption so the trust becomes a dynasty vehicle. Sit back as the trust's value grows, tax-free and protected forever. To optimize this, families choose states like South Dakota or Nevada, which allow perpetual trusts, no income tax on trust assets, and airtight privacy laws. If done right, this structure becomes a permanent wealth reservoir, operating outside the reach of federal taxation for centuries. Policymakers, academics, and watchdog groups are starting to call this what it really is: a system-wide bypass of the estate tax, legally engineered and operating in plain sight. The Brookings Institution describes the estate tax as close to a voluntary tax. Why? Because those with the means can entirely sidestep it using dynasty trusts, valuation discounts, and grantor sales. Critics argue this concentration of dynastic wealth isn't just an economic issue. It's a threat to democratic accountability. These trusts don't just preserve wealth, they preserve influence over capital markets, philanthropy, policy, and public discourse. And they do so permanently. Scholars like Eric Cades have warned that the repeal of the rule against perpetuities and the rise of perpetual trusts represent a tectonic shift, one that moves us closer to hereditary financial aristocracy, not meritocracy. Proposals to rein this in range from limiting trust durations to imposing annual wealth taxes on trust assets, to strengthening IRS oversight of intrafamily transfers and valuation games. But so far, meaningful reform has stalled, perhaps because the very families benefiting from these structures are often those shaping the political conversation. In short, this isn't just estate planning anymore. It's structural control, and the system currently rewards those who act before the rules change. The ultra-wealthy have turned estate planning into a fortress, using trusts, loans, and discounts to lock in control across generations. These aren't loopholes, they're blueprints for dynastic dominance. Until policy catches up, families who act now will own the future. Forever.